And good morning, everyone. Welcome to the Spring 2022 Quarterly Economic Commentary Briefing. Just as we're releasing the commentary today, I'd just like to first say thanks to the team and for all their inputs and for the hard work over the past number of months in putting together a commentary which changed quickly with the very fast-moving situation. I really appreciate everybody's efforts and inputs. Also like to say thanks to the broader ESRI team who contributed analytical boxes. Always a really enrichment of the commentary with the work that we get from the rest of the ESRI colleagues. So I really appreciate that. A couple of boxes in it for review. You might be interested in one Kieran and I have done on the economic impacts of the invasion of Ukraine. It's also a piece by Barra Roundtree, Mark Regan and Karina Durley on the distributional impacts of inflation, the impacts on income growth, and also a piece of work by our colleagues Kelly de Bruyne and Mert on the fossil fuel subsidies in Ireland. So lots of analytical pieces to review. So just let me share my screen. Bear with me 1 second. Okay, so the Irish economy came into 2022 in a very robust state. Towards the end of last year, the economy really kicked on as the public health restrictions began to be unwound in a more permanent nature, and as the kind of Omicron wave subsided in January and the public health measures were stood down, the expectation is that the economy would robustly grow in the coming period. The growth that we experienced last year was really big in terms of the GDP growth of 13.5%. Now, I think that was very well flagged through the course of the year last year, that was mainly due to the exceptional performance of the traded sector, in particular the very fast export growth that was experienced, particularly with the multinational and globalization activities. But that notwithstanding, the domestic economy grew quite strongly last year as the vaccination program rolled out and the public health measures were unwound in the middle and second and third quarters of the year. You can see we're expecting the growth rate for last year with modified domestic demand of over 6%, which is very strong. That notwithstanding, the very recent events, the invasion of Ukraine by the Russian Federation, the awful scenes that we're witnessing in Ukraine, really has added a layer of uncertainty and geopolitical tensions that we haven't experienced in many years. And this really is providing the context for our economic assessment at present and going forward. Obviously, these type of external shocks very hard to anticipate, and we're dealing today with a very different situation than we had anticipated in January of 2022. So our outlook has certainly changed over the past number of weeks. Those notwithstanding, within the commentary itself, you'll see we've various pieces of analysis trying to tease out the channels through which the invasion may affect the Irish economy, and the both direct and indirect linkages through various different economic mechanisms. And these are likely to cause quite a significant shock, both to global growth, to global price stability, and feedback into Ireland in both of those channels as well. Ireland being a small open economy, it will inevitably be affected by global reductions in output growth. That notwithstanding, we still do forecast a strong growth this year. Modified domestic demand is expected to grow by 5% this year and 4.5% next year. Now, one thing I would note is that is quite a markdown from what we were previously expecting for 2022, and this does reflect the risks to growth, in particular from the geopolitical tensions that we're now seeing. And this is certainly a downward revision that we weren't expecting at the start of the year. Naturally, as we saw the public health measures unwind, we saw economic behaviors and interactions renormalize from the very disruptive period of the pandemic that we've seen. We were expecting quite a kick on this year, particularly in consumption. You can see the table here presents our forecast for 2022 from the winter commentary that just gone to the forecast now. And you can see in particular around the consumption channel, the private consumption expenditure channel, we've moderated the consumption outlook quite considerably in that channel, and that reflects the general uncertainties from the war in Ukraine, but also the higher rate of inflation, which is dropping real consumption expenditure quite markedly. But regardless of the consumption situation, we've also moderated downwards our investment forecast, and I'll talk through that in some detail. I guess one of the biggest revisions we've done is to our forecast for CPI. Previously, we were expecting inflation of 4% for this year. The inflation rate, obviously, we had documented its pickup through the end of last year. There were a number of factors to that, the base effects from the previous year's low inflation activity, the supply chain disruptions that had been very evident during the pandemic, and then just rising pressures generally as demand was kicking back in, as well as some of the international energy market disruptions. We had expected that the inflation rate would peak around now in 2022 and then to moderate for the rest of the year. That is not our expectation now. We've raised more for a more prolonged period our inflation forecast. We've made it up by over 2.5 percentage points to 6.7%. So quite a marked increase in the inflation. And this really reflects the geopolitical tensions and the disruptions in energy markets, which are giving rise to the increase in both energy prices, but also the disruptions in food markets, which are leading to food price inflation. And then there's also been disruptions in general commodity markets as well. So all of these factors are leading through to our higher inflation forecast for this year. One of the things we tried to do in the commentary was think through the channels through which the Irish economy might be affected by the terrible war in Ukraine. Obviously, Ireland has relatively little direct trade with the Russia, Ukraine, or Belarus, the countries that are mainly impacted by the sanctions or involved in the war. But there are some specific items, in particular in the energy and the agricultural production, fertilizer, more specifically, where we do have some trade dependencies. And naturally, if there's any sector-specific shocks within those areas, that could be disruptive to the Irish economy. The greatest risk really for the Irish economy is just the general slowdown in international trade and the increase in the inflation rate globally. There's a number of commentators have come out with kind of early assessments of what the global growth impact will be. The OECD came out recently, and NISR, the research institute in the UK, also came out with an assessment, all pointing to approximately 1% slowdown in the coming year in the global growth outlook. So that's generally reflecting the reduced trading activity, the higher inflationary environment, and the general uncertainty. The uncertainty really comes through two main channels. That, obviously we know investment is very sensitive to uncertainty, but also households are likely to engage in more precautionary savings behavior if they feel that the outlook is darkening for both living standards, the inflationary channel, but more generally and more cautious on the outlook. As I mentioned earlier, one of the real ways in which these effects are going to propagate through to the Irish economy will be the energy markets and through the price of fossil fuels. And all the international organizations are forecasting quite a large pickup in the inflation rate of over 2 percentage points this year globally, and that's going to pass through into the Irish situation as well. There are other channels that we've listed through which there could be some effects on the Irish economy. Most notably, if there are financial stability risks at a European level, the Irish banking sector firms and households aren't necessarily exposed to say Russian debt or Russian bank exposures, but there are economies in Europe which do have these dependencies, in the Austrian, French, Italian cases. So while the financial stability risks are relatively low, at present, these are channels through which there could be contagion effects if financial stability risks do rise. So that's another area through which we've noted as a potential channel through which these effects can spill through to the Irish economy. Bringing it back to the domestic economy, to the consumption outlook, as I've noted earlier, the easing through last year and into this year of the public health restrictions certainly is positive, particularly for consumption and household expenditure. You can see from the chart here, while we haven't got back to the level of consumption experienced prior to the pandemic, there has been consistent rises since the first quarter of 2021, when we had that second severe lockdown phase. The forecast that we're putting out for consumption for 2022, 5.6%, coming down a little bit to 4.2% for next year. This reflects the fact that Irish households do still have considerable savings built up, so therefore it's likely that some unwinding of that savings balance will happen, or even just the rate of savings will unwind through this year from high levels, and that should provide a stimulatory effect through to consumption, albeit less than we had expected, given the deteriorating geopolitical situation and the increases in the cost of living. I think you can clearly see in the consumer sentiment data, which is very much real time and comes in quite quickly, that households are beginning to reflect some of these broader darkenings in the outlook into their own assessments. You can see in the commentary, the very recent data points for consumer sentiment and households' view on their own financial situation have worsened since the turn of the year. So we can see the impacts of the greater uncertainty starting to feed through into households' considerations. The investment situation is similar. Last year, there was a very large headline drop in investment, but it was mainly driven by a reversal in the investment in intangibles. And we did see steady growth in modified investment. The pickup last year in modified investment mainly reflected a rebound in machinery, equipment, and other investment activities. So there certainly was a rebound in terms of the capital expenditure commitments in the Irish economy for 2021, which is what we would have expected. You can see the investment trend here presented in the chart. In the end of last year, surpassed the pre-pandemic trend for the first time since the onset of the COVID-19 shock. I guess the investment outlook, similar to consumption, it's framed by the kind of dual tensions of the improved epidemiological and immunological situation, particularly the more permanent relaxation of the public health measures. But it's clouded by the deteriorating geopolitical outlook and the broader uncertainty that comes with the heightened political tensions and the invasion of Ukraine. All of this are likely to spill through into international business corporate investment decisions, and Ireland, being a small open economy and very dependent on foreign direct investment flows, are likely to experience slowdowns if these continue if these materialize from the international situation. Excuse me. On the domestic front, in terms of housing completions, the 2021 level was similar to the 2020 level in housing completions. We're forecasting a pickup this year and next year. That's on the back of quite strong commencements that we saw. In 2021, we're up over 30,000 commencements for last year. So both of that indicates that we will have an increase from 2021 in terms of the housing completion. So a continued strong investment increases in the residential housing sector for this year. And for next. In terms of the trading outlook, I noted it earlier, one of the reasons for the very, very strong growth outlook for the Irish economy for 2021 was this exceptional increase in exports. Now that performance was it came through a number of different channels. It came through the cross-border trade, international trade channel, but also through the globalization activities, the merchanting, contract manufacturing, and other adjustments, which increased by over 40% in 2021. So the very strong performance was a combination of both increased international trade with the multinational sector, but also the globalization activities, which both led to this near 17% increase in exports for last year. The outlook for international trade for this year and for next year is for still strong growth. Many of the multinational sectors in which we're strong exporters, computer services in particular, for example, pharmaceuticals, slightly these will continue to perform reasonably well. So we have bid into our forecast quite strong growth continuing in both of these sectors. But I think with everything else at present, there are huge downside risks to the international activity, and global slowdowns will naturally affect the traded activity of the multinationals in Ireland, and that will pass through into the activity figures here for the export channel. In terms of the labour market, that's certainly an area where we've seen quite a considerable strengthening of the domestic economy through 2021 and into 2022. We expect the unemployment rate to fall to 6.3% for this year, and to continue to fall to under 5% for next year. So you can that is a very remarkable and very rapid improvement in the labour market situation for Ireland. And while it's not unexpected given the reopening, this does come with challenges. Two factors in particular around the domestic economy that we would note as particular risks is the rapid reduction in the unemployment rate being coupled with rising job vacancies, which we've seen throughout 2021, but also expect that to feed through into wage rates, in particular if the unemployment, if there's particular sectors where there may be some bottlenecks in the labour market, it's likely that these will feed through into wage demands. The other channel that we note as a risk domestically will be if the rising inflation increases longer term or medium term inflation expectations, and that bids into wages. There's then a risk that wage rises can contribute to these kind of wage price spirals, whereby inflation, rising prices feeds into rising wages, which feeds back into rising prices. And this is certainly the risk of an improving labour market with a high inflation environment. I think this is the chart of the unemployment rate, which really does show that the exceptional performance in the year from February 21 to February 22. And again, as we say, we expect this to continue to decline throughout the year and to drop next year. So I'm going to hand you over at this point to Kieran, who's going to talk through the public finances, the analytical boxes, and the general assessment.
Thank you, Conor, and good morning to everybody. I'll just share my screen here. Okay. So as Conor said, I'll just talk from the public finances onwards. So in terms of the public finances, what we've seen over the past year has been very, a significant recovery, I suppose, of the public finances, particularly, I suppose, given the significant burden that the pandemic placed on the public finances, certainly in the first year, where there was a significant increase in borrowing and a sizable general government balance there, as you can see from 2021, and even larger again in 2020. However, the last year has seen a significant surge in tax receipts. Now, some of that obviously in 2021 was due to base effects from 2020, but you can see the kind of increases that we observed: 17.5% increase in income tax, VAT up 24%, corporation taxes again increasing very, very strongly, significantly larger than most forecasts, and excise duties up as well. Last year also saw lower government spending than was initially expected. So that came in at around 1.5% lower than what was allocated in budget 2021. And so that overall meant that the public finances are actually in quite a good position, given the significant costs associated with the pandemic. And you can see our forecast there for the headline kind of fiscal metrics, the government general balance as a percentage of GDP, and then the debt to GDP ratio. And we can see in 2022, at the present time, we expect to see a surplus, a mild surplus of 0.2%, growing next year. And then as a result, the debt to GDP dynamics improving quite significantly over the next couple of years. And we express those as a percentage of debt to GNI star in the document. However, along the lines of what Conor has discussed in terms of the effect of the war in the Ukraine, there's no doubt but that there is significant downside risks to the public finances associated with this. And I'll cover those a little bit later in terms of the overall assessment. And these could have a significant impact on the trajectory of the public finances. The next item that we want to discuss there, if I can just move it on, is inflation. And again, this is another area which is likely to be significantly impacted by the war in the Ukraine. As of February, Irish inflation was increasing by 5.5%, just over 5.5% year on year. Obviously, that increase, while significant and large in itself, doesn't factor in the impact of the war. And as we discuss in the document and discuss in the box that Conor alluded to earlier, clearly one of the major impacts of the hostilities in the Ukraine is going to be on inflation, whether it's coming through the energy price channel, whether it's coming through commodity prices in general, or whether it's coming through agricultural prices. And obviously the impact, particularly in areas such as cereals, both the Ukraine and Russia being significant producers of wheat, and the impact that is likely to have on food prices. So overall, even though the inflation rate is running at 5.5%, it is likely to be larger than that for the rest of the year. And obviously, we've revised upwards our forecast the present year for inflation to run at 6.5% or 6.7%, and then 5% next year. But again, there is upside risk in the sense that that inflation rate could even go higher depending on how the situation pans out over the next period of time. Our colleagues in the TWP program, Karina Doorley, Mark Regan, and Barra Roundtree, have a very nice analytical box in the commentary, which essentially looks at the distributional implications of some of the recent measures that the government introduced to deal with the higher inflation. So in particular, their box looks at the cost of living package, which was announced in last February the 10th, 2022. And also it incorporates in an analysis of the cut in excise duties, which was just announced very recently on March the 10th. And so the TWP team do their kind of customary distributional analysis of that in terms of the impact and who, if you like, there is some mild increases in income as a result of these measures. And they note that, the benefit, if you like, is particularly felt by those at the lower income decile level. So that's the overall conclusion. There is a policy conclusion there as well, which we would very much share in the commentary, which is that as inflationary pressures continue to put a strain on many households, there may well be a need for further measures down the line as far as the government is concerned. And I think the important aspect to any future measures is that they would be as targeted as possible in terms of being directed at those households that most need, if you like, insulation from the inflationary pressures. And I think that's an important point. Just moving on then to the risks to growth overall. So as Conor has talked about a lot of these factors, and we discussed them in the box, the analytical box by myself and Conor. It's clear that a lot will depend on the duration and scale of the conflict and the war in the Ukraine in terms of its overall impact on the global economy, and obviously Ireland being a small open economy, we're particularly dependent on global activity. We will be impacted in terms of that overall channel, in terms of the impact, the negative impact and adverse impact that the war will have on overall trade, if you like, global trade. Also, it affects, has an impact on uncertainty, particularly as far as investment and consumption decisions are concerned by households. But the other major channel, of course, through which the conflict and the war will have an impact on the domestic economy is through the inflationary channel. And as I said, that's likely to come down through further pressures as far as energy prices are concerned, and then particular price pressures as far as commodity markets and agricultural products are concerned. As I said as well, the public finances, although our assessment at this point in time is that we expect to see a mild surplus, and the fact that the public finances have improved quite significantly over the last year or so does give the government some cushion to deal with the pressures which may come down the track. But there's no doubt that there may be a serious impact as far as the public finances are concerned. We may see, for example, further transfers to households to deal with the higher inflationary pressures that are there. There may be need for support to sectors that are particularly impacted by the overall deteriorating geopolitical situation. And there's also the additional cost as far as dealing with the humanitarian crisis. So clearly, there may well be additional fiscal pressures as far as that is concerned. We also in the commentary continue our assessment of climate change and climate-related issues. And this, I suppose, has become even more topical given all of the discussion about the energy markets and the pressures that we are seeing and witnessing there, and the changes, radical changes even that we're seeing over the last couple of weeks and months. This is a box by our colleagues Kelly de Bruyne and Mert Yakut, mainly drawing on their research in the area, and in particular, the box focuses on the issue of fossil fuels. And this is something which maybe doesn't get quite as much attention in terms of the climate change issue as, for instance, the issue around carbon taxation. But the box, I think, very nicely discusses the overall impact of both fossil fuel subsidies in comparison with carbon taxes, and makes the point that, there can be sizable if you like, reductions achieved in carbon emissions and in terms of us achieving our environmental targets through targeting subsidies in the fossil fuels area. And indeed, the box has some scenario results in there from the use of the I3E model that Kelly and Mert use in terms of giving a parameters around the kind of impact that changes in these areas could have. And they also draw out some policy conclusions, again, highlighting the areas and sectors of the economies which could be most impacted by these changes, and therefore the need to ensure that these sectors are insulated in somewhat the same way that the government has sought to do as far as introducing carbon taxes, diverting welfare, if you like, or resources to areas and to sectors of the economies that would be most impacted by changes in that regard. So overall then, in terms of our assessment, I think it's clear that there's kind of two obvious, if you like, countervailing pressures at play as far as the Irish economic outlook is concerned. On the one hand, the economy has come out of the pandemic in a very strong, robust manner. Indeed, it managed to get through the pandemic in a very resilient fashion. And so therefore, the outlook for the economy would have been very positive, clearly in the absence of the geopolitical issues. However, there's no doubt that the war in the Ukraine and what we witnessed over the last couple of weeks is likely to lead to very significant changes going forward. Clearly it'll have an impact in the short run in terms of the negative and adverse impact on global economic activity, which will feed through undoubtedly to the domestic economy. But there's also obviously been other changes afoot, particularly in energy markets. These are unlikely to be reversed in terms of some of the commitments that are now being undertaken, particularly at the EU level. And at the broader global level, in terms of substituting away from Russian oil, gas, etc. These are likely to put have additional impacts, if you like, on the European economy going forward. So clearly there are changes afoot which are going to have an impact. One of the major areas clearly is through the inflationary channel, as we have discussed. And also, as we said, whilst the outlook in general is quite positive as far as the public finances are concerned, there's no doubt that there are significant downside risks in terms of the impact, particularly of the war in the Ukraine, on the overall fiscal situation. So that's the overall assessment.